Now, we heard a rare admission this week from the central bank governor, Paul Njoroge, that economic growth alone is not enough. The composition of that growth matters. The governor said, and I quote, "It is true that you have GDP numbers, but you can't eat GDP." And that is the point, isn't it? What is growing in the economy matters, and economic growth should be reflected in ordinary citizens' pockets as well. So this brings us to the question of inflation. A report that was released Thursday by the National Bureau of Statistics indicated that Kenya's inflation rose to 4.95% in October. That's up from 3.83% in September due to soaring food prices. Maize flour topped the list of foods whose prices had gone up significantly, making the lives of most Kenyans more difficult. The price of a kilogram of loose maize grain rose 5.82% in October to average 50 shillings, almost double what it cost last year. A 2-kilogram packet of maize flour can now cost as much as 140 shillings, the highest price in the last 3 years. And while these inflation figures are within the government's target, they are not within what most Kenyans can afford. Other indicators of the economy also beginning to look down. Although last year the economy grew at 6.3%, the highest achieved by the Jubilee administration, according to the National Statistics Bureau, this year the economy has registered slower growth, at least in the first 2 quarters, at 5.6% compared to 6.5% in Q1 and 5.6% compared to 6.4% in Q2. Now, last year, despite the relatively high GDP growth, the economy created just 840,000 jobs, and that is way below the 5-year average. The number of formal jobs created were 78,400, and this was the lowest since President Kenyatta took office, and 43% lower than the 2014 level. And while the informal sector continues to create the largest numbers of jobs, the private sector can barely keep its doors open. Media reports place the numbers of Kenyans who have lost their jobs across various industries in the last 1 year as nearing about 20,000. Now, we want to show you some firms on the screen very shortly. And the firms you're about to see, some of them the cream of the private sector and the best employers taking in the best and the brightest of Kenya's society, are struggling to keep their doors open, with others shutting down entirely. Finally, of course, there's a question of the rising public debt, which the government now says is the only way to ensure that we can meet our debt repayment obligations. Now, yes, we need more debt to repay existing debt, which is currently due. Public debt is now at an all-time high of 5.89 trillion shillings, even as revenue collection targets are revised downwards. 43% of all domestic debt is expected to mature in the next 1 year. This even as the Treasury is revising tax collections downwards as more companies struggle to post profits. Treasury Cabinet Secretary Uku Yatani has now worryingly admitted that we will not be able to meet our loan obligations unless the debt ceiling is raised.